Today on InvestTalk, we discuss 8 ratios you should consider when analyzing a company's stock. Then we dig into the light holiday trading and markets. I also answer questions about Johnson & Johnson, Uber, Intel, and more. And at the end, I look at a story about how more and more young people are gambling in the options and crypto markets.
This is InvestTalk, independent thinking, shared success.
Our main focus point today is about financial ratios and how to analyze them. And we talk about these all the time, but we'll dig in here a little bit about the details of why we follow certain financial metrics. And there's going to be 8 here, but I'll give you a few more kind of similar metrics to follow that can be just as useful. Okay. So this is for individual stocks, analyzing individual companies. This is not when you're looking at an ETF or a mutual fund or anything like that. It's how to analyze the underlying business and how much you're paying for that underlying business. Okay. Now, earnings per share is the most commonly quoted metric, how much they earned last year. And it's simply calculated by dividing the company's net income by the total number of shares outstanding. And executives have a lot of control over the accounting practices, and that means they can, in some ways, manipulate net income on a year-to-year basis, even a quarter-to-quarter basis, and thus earnings per share. So that's why you don't want to take earnings per share at face value. You want to dig into the details. And it doesn't tell you a whole lot about the trends of earnings per share. Oftentimes doesn't tell you a lot about the underlying trends of the business. Why is that? Because, as I said, from accounting practices, that can manipulate earnings per share, but also that's on the net income side, but also the shares outstanding. So, for example, a leader, an executive, can leverage up the balance sheet of a business, borrow a bunch of money, buy back stock, therefore reducing the total number of shares outstanding, but the profit of the business can stay the same, but it looks like earnings per share is rising. So understand that earnings per share, how it gets there, right? And what are the trends and why are those trends in place, okay? And that goes to P ratio. So that's taking the total company's stock price divided by earnings per share. That's pretty simple. This is one everyone quotes. But once again, it's the earnings per share that can be manipulated. And then the market cap, the company's stock price, is not including debt. So understand that there are a lot of flaws in just simply analyzing earnings per share and P ratio. Okay. But you need to know how they're calculated. You know what they mean. You know that the inverse of the P ratio is the earnings yield, and you can compare that to other yields and other investments like bonds, et cetera. And you have to understand those concepts. Okay. Now, the third is return on equity. This is simply dividing trying to calculate the return of a company generates on shareholders' capital. And it's calculated by taking the net income divided by shareholders' equity. The higher the company's return on equity, the better the underlying business. Now, that's just shareholders' equity. There's also called return on invested capital, which takes net income divided by equity plus debt on the balance sheet. Okay, the total capital that's going into the business, not just shareholder capital. Okay, and that's another one that can be useful as well, because return on equity can look really good if the company has a lot of leverage. And as you know, leverage can cut both ways. And so that's why return on equity and return on invested capital are both good metrics to follow. Now, then there's debt to capital ratio. This is when you want to understand how a business is financed and whether it can support its debt level. So it's adding short and long-term debt and divided by the company's total capital. Okay, so knowing how much of their capital base is debt versus equity. And if it varies depending on the industry. The higher the ratio, the more the company is in debt. And you typically want it below 40%. But once again, it depends on the business. More cyclical businesses, you want those to be lower because their profits can go up and down. Steadier businesses, they can support higher amounts of leverage. Think utility companies. Talk about that all the time. Their profits are legislated, and so they can have a bit more debt. Then there's interest coverage ratio. This is simply by taking the EBIT, earnings before interest and tax, dividing it by the interest expense. So saying, okay, what is the underlying business creating in profits? And then can it support those debt payments? The higher the ratio, the healthier the business is. But once again, cyclical companies can handle that. They need higher interest coverage ratios versus ones that have more consistent businesses. Then there's enterprise value to EBIT. This is a good ratio, a much better ratio than a P ratio to follow, because enterprise value is not just incorporating the market cap of the company, but adding any additional debt or subtracting cash from its enterprise value. So the market cap might be, say, 100 billion, but if they have $20 billion in cash, really, if you want to buy the whole company, you only need 80 billion, right? Because net, you're going to get 20 back if you bought the entire 100 billion, right? So it's and vice versa. If they have $20 billion in debt, but the market cap's 100 billion, well, you don't really own everything when you buy the whole company for 100 billion and you still owe 20 billion, right? You still need to pay off that 20 billion. So that's why the enterprise value is a better metric to use than market cap. And then EBIT, just to more easily compare actual operating earnings of a business with other companies that may have different tax rates or debt. Operating margins, another great one, dividing by a total operating profit divided by revenues. That's a great one to follow as well. So hopefully gave you a good rundown of how to think about these ratios and metrics so you can do the proper analysis. Enhance your investment knowledge. Subscribe to the KPP Premium Newsletter for access to exclusive content and expert advice. Now let's take a quick look at the market today. It was a decidedly positive day overall. You had, let me pull this up here. You had the Dow was up 28 points. The S&P actually was down 2 points, but that's because large cap growth was the big drag on the market overall. You had that part of the market was down about 0.5%, and that's because of Tesla. Tesla was down. Let me pull up the heat map here. That was up 1.75%. Sorry, down 1.75%. Amazon down nearly 1%. Meta down nearly 1%. Apple and Nvidia were roughly flat. Same with Google and Microsoft. Meta was down 0.75%. So you had some big drags on the large cap growth. AMD down 1%. Only Broadcom was the solid red name in that space, but that was the big driver to the downside in the S&P. The Nasdaq, that was down. But if you look at the broader index like NYSE, that was up about almost 0.2%. So that was fine. Once again, it's light volume. We're after Christmas. We have tomorrow, Monday, and then Tuesday, and that is New Year's Eve. So we only have 3 more trading days, call it 2.5, right? Because New Year's Eve is a half day, I believe. And so, that's where we're at. The year is rapidly coming to a close, and you typically have light volume, which doesn't mean much movement one way or another. And if it means any movement, it's likely to mean to the upside in a modest way. And that's kind of what you've got today. A lot of very, very modest moves to the upside.
Hi, Justin and Luke. This is Kyle from Michigan. I want you guys to look at Fidelity National Information Services, ticker symbol FIS. It looks like a pretty good stock to me, but I was wondering what you guys thought about the stock. And if you like the stock, what price would you consider buying it? Thanks, guys. I'll be listening to your answer on the podcast.
All right, looking at Fidelity National Info Services, provides banking and payment technology solutions, processing services, and information-based services. A name that earned a ton of money in 2021, $6.55. It was an all-time high, but it peaked out in both earnings and price. It peaked out around $155, $160 per share, and hit a recent low as $46 or so. And now we're up to 82. It's an uptrend now since that bottom. That's the positive. It has been weakening lately with kind of the overall market. And this is still a large cap name, $44 billion. It's now below the 100-day moving average. So I think the technicals, I wouldn't say they've broken, but they've certainly moved from bullish and a solid uptrend to more neutral. I'll say that from a technical perspective. Okay, so that's from the technicals. Earnings is supposed to be $5.24 this year and $5.70 next year, up 9%. 1 3/4 dividend yield here. And let's take a look at, let's see, they do have some debt on their balance sheet, about $9 billion in net debt. Enterprise value to EBIT is around 13 times. And that is kind of in line with where it's been over the last 10 years. So I think it was pretty undervalued later last year. And now it's starting to become more fairly valued, shall we say. Return on equity went negative for a little while, but now it's back up to 8%. Historically, this is kind of where it's hung out, return on equity in the high to mid single digits. And that's okay. That's not a fantastic number. You look at the free cash flow, about $3.2 billion on this enterprise value. That's about a 6% free cash flow yield. Okay, but once again, not amazing. But free cash flow has bounced back from the big dip. It peaked out to about nearly $4 billion, hit a low recently about 1.5. Now it's at 3.2. So they've righted the ship a bit. It's decent profitability, decent balance sheet, decent chart. So everything's kind of like above average here. It's not amazing. Nothing's amazing about this, but it's a solid company on a nice comeback. So I don't mind it as a play here. It's starting to buy back shares with some of that cash. I think that's good. So overall, I give it, it's pretty good, but not great. I hope you've been telling your friends and family that our InvestTalk audio podcast is available in video form over on our YouTube channel. We get questions submitted over there all of the time. And let's cackle one of those right now. And I, the GOAT 249 says, my name is Brian from Ohio. I've been listening to your show since 2019. Appreciate that, Brian. You guys are top notch, and I appreciate all the info I've learned. Can you please review Intel on the show? I'm mainly interested in the risks associated with the company. If you have reviewed it recently on one of your shows, I missed it. I apologize. Yeah, we talk about it from time to time. Oh, well, the risks on Intel are fairly simple. It is all about whether they can really catch up to NVIDIA and AMD. Now, I think AMD being better than Intel is a little bit extreme, but Intel certainly had the lead for a long time in technology, and they allow that to slip away. They focus too much on the numbers and not on the technology. And this is very common in many businesses, but especially technology businesses, where you bring in a McKinsey type of leader that just focuses on margins and sales and tries to squeeze every ounce of profit out of their great products that was built by somebody else. And what that typically does is allows competitors to come in, undercut price, and focus on innovation, focus on expanding their market share. And oftentimes when the leading company takes their eye off the ball of creating great products or service, they lose their edge. And that's what happened with Intel. Now they've had a new CEO here for a little while, I think close to 2 years now. But I think it's going to be a slow progress to get back to where they need to be, which is a place of technological advancements and cutting edge technology, and being able to fight back on that front and have the tools to. And in some ways they're making headway, but it's slow. It's hard to regain your advantage in really any industry, especially a difficult industry like Intel or like the semiconductor space. So the risks are that they just don't catch up, that the new leadership is not set out to succeed, and they just don't, right? That's the risk. But if you look at the quality of their brand is still there. People still want Intel chips in their computers for the most part. NVIDIA, obviously, the graphic chips have become far more important than they used to be in many applications, including AI and gaming. But I don't think that Intel is going away. They're losing money this year, but a lot of this has to do with kind of restructuring the business and setting itself up for the next generation. And I could easily see them succeeding. They have a lot of support from government, and that's really what you're betting on here, is that they will return to at least somewhat prominence. They don't even have to get back to where they were before. Just getting a leg up in certain parts of the chip space. And I think this would be a gangbuster investment. But there's a lot of risk there. Now, the technicals are firming up here. If I took a look at the daily, it has found a floor here in the high teens. And as long as it holds that, then I think this is a good risk versus reward for the upside of Intel.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos.
Yes, this is Brett calling from California. I wanted to get your insight on a company called, this company Costco. I'm just trying to get in a high value company and it has good, strong fundamentals. I know the share price is kind of high. I just wanted to see if you think it's a good long-term investment and just dollar cost average it. Thank you.
All right, looking at Costco, it's a name we do own in one of our strategies, have for a while. We've trimmed it a bit as it's gone up because the valuation is a bit elevated right now. I will say that, even though it's supposed to earn about $20 per share next year, it's a nearly $1,000 stock. But so you're talking about a high 40s PE multiple, even looking forward. That is. Pretty extreme for any company, especially a company like Costco, which isn't a huge grower, right? It's not a company that is growing 40, 50, 60%. It's pretty mature. Revenues last quarter were up 8%, earnings are up 10%. And that's pretty much what it grows, kind of in the high single digit, low teen range on profits every year. And it has a great franchise, huge profitability, but right now, enterprise value to EBIT's around 40. That's pretty high. That's very high. Return on equity, 32%. Return on invested capital, 25%. Both great names. Now, if you're going to do a dollar cost averaging approach, meaning over the next 5-10 years, you're just going to buy a certain amount every month, every quarter, a couple $100 here or there, then that's fine. I think that's a good way to do it because this is not a place that you want to go all in on Costco because of the valuation. Now, we continue to hold it mainly because we still like the business. We still, the technicals are fine. There's no red flag that's going to roll over in the short term. If you start getting that sign, then we'll probably cut it even more, eliminate it. But from a long-term perspective, this is not the greatest, kind of entry point. But I do like it as a business and as a dollar cost averaging approach over a number of years. This would be a good name. There's another question from our InvestTalk YouTube channel. Edwin Rowan 2272 says, I recently received retroactive payment of around $50K after my company signed a contract. I'm 34 years old, have no credit card debt and a low mortgage rate. I contribute to a 401k and 457 plan, but there's no company match since we have a good pension for retirement. I'd like to explore ways to minimize the tax impact on this retroactive payment. What are some strategies or options I should consider? Well, the first is try to max out your 401k or 457 for the year. It's going to be a write-off for you and offset a lot of that 50K. That's the way I would go about it. You can also contribute to, I don't know what your total income is for the year. You may still qualify for a Roth. If not, I would go with a traditional IRA. You may qualify for that as well. That's something to talk to a CPA about. Probably rather than us, these type of strategies. And these are things that I'm a firm believer a good CPA is worth it for the vast majority of people. Now, if your life is very straightforward, you rent, you just have a job, you don't really have a lot of reasons, any complexities to your situation that warrants a write-off, then yeah, maybe you can just do a TurboTax thing. But when you start to getting these retroactive payments, you have a house, you have 2 different retirement accounts. This is where a good CPA can kind of come in and give you a bit better advice that's specific to you based on your income, what state you're filing in, how you're filing. Are you filing jointly or a single, etc.? These are factors that have to be considered. So you gave me some information, but not enough to give you, I think, a full answer. Thanks for the call. Now let's talk about a new problem. And this is the new addiction a lot of people are having to the stock market, to just betting markets in general, from crypto to options. This is something that more and more Gambler Anonymous meetings are being made up of people that aren't just gambling on sports or gambling in casinos, but they're gambling in markets. And they have thousands of dollars in trading losses. They're borrowing from loan sharks to double down on their favorite type of investments. And one man in this program said options are the crack cocaine of the stock market. And this is becoming a bigger and bigger trend. And so a lot of these people are struggling with addiction, similar to sport betting on apps, but they're using places like Robinhood. And they're drawn into the potential big wins on meme stocks and other cryptocurrency, etc. And it's become so easy. Whether you're on Coinbase or Robinhood, they make it like a game, just like a lot of the gambling apps. And so they're betting on Dogecoin or Tesla or Nvidia, and they're using leverage in order to try to hit it big. And more doctors and counselors are seeing more cases of compulsive gambling in financial markets and being unable to control their urge to make the next bet. And Wall Street is not helping. They're introducing newer ways. Think of MicroStrategy. Now they approved a double leveraged MicroStrategy ETF. And people are using leverage upon leverage, which compounds the risk for investors. And we know the average investor typically has bad timing. And so this is a trend that is not stopping. Pennsylvania's gambling hotline has fielded more calls tied to gambling in stocks and crypto since 2021 than it did in the prior 6 years combined. Spokespeople from like Robinhood, they'll say that they have safeguards, help customers be more informed, but they also make it fun, right? They make it something that is designed to seem like a game more than serious investing. And activities in options is on track to smash another record this year. And it's really about same day options, which are the riskiest part of the option market. And these same day options make up more than half of all trades in the market for S&P 500 index options this year. These are YOLO options, right? They're small dollar amounts with huge potential payout, but the vast majority of them lose it all. Yeah, you might lose, $10, $15, $20, and it doesn't seem like you're losing a lot, but when you do it day after day, it adds up. But everyone's enticed to think that, all I have to do is hit one big trade on one day and I can make up for all my losses and then some. So there's a lot of psychology around this that is leading people into the poorhouse. And some are suicidal because they've lost so much. And so I wanted to highlight this because, the big question is this healthy? Is this healthy for markets? Is it healthy for the country? There's a certain level of nihilism as well. It's like, why not? I have no other way to make it big besides this. And so there's a social aspect to this as well. And it's really sad to see, because we are here on InvestTalk talking about investing, and that's not what this is. This is speculating. This is gambling. It's really what it is. And it's sad to see that a lot of people are turning to this. And I just hope that you as investors don't turn to speculators. You stay investors, because that is the way to wealth over the long term. And, it's not as exciting. Promise you it's not. But it's far more likely to succeed. Here comes a question from a gentleman in New York that likes to call InvestTalk every now and then on 888-99-CHART.
Hi there, Duncan from New York. Thank you for all that you do. Quick question on stock ticker OXY, Occidental Petroleum. I think that's the stock that Warren Buffett bought. I'm actually at a 31% loss for the entire year. Thinking about taking some capital losses right now. But there was a caller last episode that talked about ONEOK. That stock ticker is OKE. Just wanted to know which company you value more at this stage. I know ONEOK actually has a better dividend yield, I believe, but looking forward to your answer. And just want to think of what you thought of that capital loss strategy and then putting it into something, I guess, hopefully better. Have a great day. Bye.
All right, looking at Oxy versus ONEOK, and we've owned ONEOK for a long time, OKE, and it's been in a consistent uptrend, and it had a nice jump after the Trump election, because what they do is it's a pipeline company, so they move the products from the drill site to where they're eventually used and sold. And that is a great business. And so the idea is that there's going to be more drilling and that there's going to be more use of their pipelines. And that's why it moved up. Now it's kind of a return to where it was pre-election. But that's kind of been the whole oil patch. It's sold off. But Occidental is a different type of business. That's a traditional E&P company. It has more debt. It has more variability of its revenues because of it's more tied to the price of oil, versus ONEOK is more tied to the volume of oil moving through their pipes. And so we would rather own ONEOK over Oxy, which we do. We don't own Oxy. And this is another good example with Oxy that you don't just follow because Warren Buffett does it. I see this all the time. Hey, Warren Buffett about this, or Michael Saylor about this, or whatever, right? You're just following these people who bought something. And sometimes that can work out, but more often than not, it doesn't, because you're not buying it at the price they're buying it. You're buying it much higher. And, they have ability to hold through down cycles. And obviously Warren Buffett certainly has that ability. And, they tend to buy good businesses, but good businesses can have rough times and vice versa. And so a lot of times you get caught up in those losses and that downdraft, and something that Warren Buffett probably doesn't do much tax loss selling, although it looks like you're looking to do that. So I would go trade Oxy out for ONEOK. I think it's a better, more durable company longer term, not because of the dividend, has nothing to do with that, it has all to do with the quality of the business. Thanks for the call. Now we've got a live call. Bill from Northern California asking about Uber and listening on AM 1220 KDOW. How you doing, Bill?
Hey, Justin. Thank you. I'm fine. Happy holidays. I'm glad to hear you're working today. I wasn't sure if this would be a live show today. Appreciate it as always. And
no problem.
So I have some of the stock, and I bought it over time this last summer.
Mm-hmm.
Up to the last time I bought it was down to like $59 back maybe the beginning of August with that drop.
Mm-hmm.
And some average cost, in the 60s, high 60s probably.
Mm-hmm.
But, I consider it more of a speculative play, and I just it's a very small position for me.
Mm-hmm.
I just kind of want to get your overall perspective. I understand a lot of things about the company, but your insights are always very interesting. So
okay. Well, we're heading to our final break. So after the break, I will get to my answer on Uber. To enhance your financial knowledge, check out our website at investtalk.com. Now, before the break, we had a question about Uber from Bill in Northern California. And Uber has pulled back about 30% from its 52-week high, which was around $87 per share. Now we're at 61 and change. The technicals are certainly weakening here. And I think it has to do with the multiples that it's trading at. So it's around $2.38 next year. But it's trading on the expensive side. But what I am liking about the business is cash flow is now consistently positive. EBITDA and EBIT continue to power higher and stay in positive territory more than just a couple of quarters. And so, the average consumer is becoming more used to using Uber and Lyft, and their Uber's still the big player here when it comes to food delivery and obviously taxi-like services, ride sharing. So I'm starting to like Uber. The technicals, though, are starting to weaken, and I think there's potentially more downside here into the high 30s, around $40 level. That's where I think it'd be interesting to pick more up. Now, as a long-term hold within a portfolio, I have no problem with it. So, it's a name that's going to be volatile, and you have to be prepared for that volatility. Let's take another live call. Richard from Santa Clarita. He's inquiring about Johnson & Johnson, and Richard, who is listening on AM 1220. How you doing, Richard?
Hi, good. How are you doing, Justin?
Good. I hope you having a happy holiday. So you're looking at Johnson & Johnson. You're trying to buy it, or you own it?
I have a small position in it, and maybe to increase it. The thing about Johnson & Johnson, never consider it's not a growth stock, kind of a value stock, but always looked at seeing when this hit in the 140s, I thought it might be a good buy. It is in the 140s right now, but given the economic conditions and the future regarding pharmaceuticals, with the possibility of Robert Kennedy and so forth, I know the healthcare pharmaceuticals area has been a kind of a tough one for the projectile, but this is a huge company, and I just wondered if at this point, it's is low. It's getting down there. If this might be the time to get into J&J.
Well, I think you're kind of hitting originally on the big problem here. Is you have a new administration with RFK as the head of the NIH, and he's looking to change a lot of how the healthcare industry is ran, and especially in the pharmaceutical side. Now, this also has a medical device portion of their business, and I think that will probably be more insulated from the new administration. But that pharmaceutical side, like you said, it's a large business, and they spun off their consumer business. So it used to be pharma, medical devices, and consumer, but Kenvue, I think is how you say it, was spun off last year. And so now it's even more concentrated in pharma and medical devices, and about half its revenue comes here in the United States. And this is in a downtrend. If you go to a weekly chart, it's been in a consistent downtrend since its high. Let's see, when was that? Back in early 2022 at around $185 per share, and it's making a consistent series of lower highs and lower lows. So the technicals are bearish. It has a good balance sheet, that's positive, but there's not much growth here. There's potential for that pharma side to have certain drugs maybe taken off market, maybe certain prices get reduced because of political pressure or legislation. There's just a lot of potential risks here of a company that does $22 billion in revenue per quarter. It's easy for it to be in the crosshairs of the new administration. So I just don't see, there's opportunity cost when you're going to put money into something like Johnson & Johnson. You could also put that money in something else. And so if I'm going to buy something in the medical space, I'd rather own a pure play medical device company as opposed to a pharma name. And so that's why just Johnson & Johnson isn't on the list for me. I'd pass on it. Thanks for the call. I'm Justin Klein. It's another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and your financial picture. by heading over to investtalk.com, clicking on the portfolio review button. This is a free and confidential service. If you haven't optimized your 401k potential, we can help you do that as well by heading over to investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.